Today, I will share all the macro data, both good and bad, that can help you decide if Nifty is going into a bull run or a bear market over the next few months. I will try to keep my bias out of this as much as possible while spending less than 30 seconds on each factor. We will start with the macro view, which includes global trade, geopolitical news, commodity prices, fiscal policy, and growth. We will put each of these in one of three brackets: negative, positive, or neutral. We will do the same with India's local economy, including GDP growth, fiscal policy, consumer demand, and valuations. 9 factors, and we will spend less than 30 seconds on each. Starting with global trade. Tariffs have broken the system. Even if all tariffs are recalled, the fact that China and Canada are working out deals while US and Russia are deliberating working together on Gaza shows us that the world in 2026 is more similar to 1940 than 2020. India did sign trade agreements with Europe and the US, and that is a huge benefit. However, global trade must be kept neutral for India just for the amount of uncertainty that still persists, though I can even argue for it being negative globally. The geopolitical stability cannot be more obviously negative. We are one missile away from the Hormuz Strait getting blocked, essentially halting India's growth story overnight. China has been preparing for a war with Taiwan for 2 years now and seems about ready to begin that. South America, Africa, Europe, and Asia are all reeling under greater violent stress than ever seen by almost anyone alive. So geopolitically, extremely negative. Commodities are also becoming more expensive again. Aluminium and copper are near all-time highs, which tells us a lot about where inflation is heading. Gold as a safe haven could not be warning us any louder, and the recent volatility tells us that margin pressures are creeping in. Because of the rising inflation expectations both from commodity prices and tariffs, central banks have been forced into a stalemate. They cannot cut rates because that guarantees entrenched inflation that wiped out 80% of the wealth in 1970s. They cannot raise rates because that guarantees that the AI bubble pops instantly. So we're in a place where if the world economy goes into trouble, we do not have the central banks to save us. The exact recipe needed for a great crash in the post-GFC era. It's a clear negative. Growth in the US and India looks great from a distance, but India's earning growth has slowed to low teens, and that too mostly driven by just small caps. The US's growth is artificially propped up by massive investments in AI and outsized expenditure in healthcare. Neither of these is sustainable growth. There is no real revenue, current or future, coming from AI. Remember when Sam Altman said he would only use ads in ChatGPT as a last resort? He is using it now. That tells us all we need to know. Negative. Well, globally, it does not look so good. 0 to 1 to 4. Let's see if India domestically fares any better. Our GDP growth has slowed down, naturally, since we grew too fast for a couple of years. Not a negative, since we are still seeing double-digit earnings growth and government Capex has picked up sufficiently. At the same time, rural consumption is picking up, which offsets the dip in urban consumption. Net-net, this is positive. Now, most of the pickup in consumption has come in because of policy changes. The GST cuts and RBI's massive liquidity injections have helped avert an imminent crisis, but they haven't helped us cross the bridge. Now we are in a position where the government cannot cut any more taxes and the RBI cannot cut rates or inject any more liquidity without causing a death spiral of inflation. So the fiscal policy is negative. It can no longer support us in a downturn. Consumer demand is unstable. People are going out less, vacationing less, buying fewer cars, and spending less on discretionary consumption in general. Most of India's consumer demand has been held up by rural demand. That's good for bringing equality into the system, brilliant, but that does not have enough margins or revenue to create earnings growth for Nifty 50 stocks. Not negative, but definitely not positive. Neutral for me, but let me know in the comments what you think. Valuations are still stretched. Remember, we are actually at a 26 to 28p and not the 22p that screeners charts would show you. I discussed this in my live session. We've changed how we calculate earnings, moving from standalone to consolidated. Of course, news channels won't cover it, but we know better, don't we? In fact, most of Nifty is still massively overvalued. The 26 PE is also dragged down by PSU stocks like SBI, LIC, IOC, and NTPC trading at single-digit multiples. Private banks are also trading in mid to high-teen multiples, while metals, infrastructure, and consumer-facing companies are trading at historically stretched valuations, and that too at peak earnings. This is perhaps the biggest negative for India. And there you have my final score, 1, 2, 6. Let me know in the comments what your score would be.